Meme stocks. Let's talk about the financial circus we can't seem to look away from. Today, we're diving into the madness behind the moves, why call skew goes vertical, how options fuel the fire, and whether there's a trade in all this chaos, or is it just entertainment? Let's get at it after the bell. Okay. One of these days, I'm riding on a goddamn horse. I'm telling you right now.
One of these days, you're going to have a fade out.
I know. Good morning, boys. It's already Thursday. What the heck? How's it going?
Going all right, Lex. How you doing?
Good,
how you doing, Mark?
Good. Going well. So today, meme stocks. They're back, apparently. Let's start from the beginning. You know, I know we assume everyone knows what all this stuff means, and let's pretend they don't. So meme stocks, how would we define those? What's the best way to start, would you say? Jason, you had a decent definition.
I mean,
before we started.
Yeah, my definition is more technical. A meme stock to me is an equity that the spot vol correlation is positive. That is, when the price of the stock goes up, so does the volatility of the price. That kind of matches Mark and I guess Mandy from CBOE, their observation of call skew shooting up when these stocks get active again. So I think that kind of matches, basically all observations of what a meme stock is.
Sure. Okay. Mark, what do you think? Anything to add there?
Yeah, no, I think call skew is a very significant feature of, most of the contemporary meme stocks. I probably would approach it from a volume definition. Like, I think that's another lens you could look at it from, where you see a surge in activity, particularly if you want to break down that volume by clearing code, particularly retail, that like if you see a surge in activity, independent of an earnings announcement or something like that, or maybe it is related to some news, but generally significantly above average activity.
Okay. Right. So the famous one or infamous one of the last several years would be GME, GameStop, right? That was sort of the one that kind of lit the fuse a little bit and brought it to the forefront. And it was interesting that catalyst started with what was his name? Roaring Kitty.
Yeah.
And, right. He was kind of a Reddit guy or a Discord guy, and he had a big following. And he was posting what he was doing, and it sort of caught a little fire. His buying of upside calls and out of the money calls. Now, I always tell people, and I speak about this when I travel a little bit. This particular instance, people say that he manipulated the market. I'm like, he didn't manipulate any market. He put his money at risk and bought calls, and he basically said, hey, I have a belief. He could have lost every nickel he put into it, right? So yeah. I don't have any issues with that part of it. But what I want to also chat about, and we'll get to that down the road today, is I think this is where Jason's kind of beliefs about gamma squeeze and charm sort of have a more significant effect than in something like SPX. Because these stocks, these meme stocks, the liquidity tends to be held by a smaller group of people or group of entities, and there's far less liquidity to kind of hedge things off in. So they kind of get stuck holding the bag a little bit, and you could see some of this, these gamma facets playing out a little bit more profoundly, right? Any thoughts, pro or con, against that concept?
Yeah, I think it's not just the gamma, but the fact that there's a lot more notional traded in options than there are in the stock itself.
That's a good point.
And the float is so small. And the float is small, the short percentage is high, and there's so much existing gamma out there, primarily on the call side, that it kind of sets the tone for this.
Sure.
Roaring Kitty, he bought up a ton of upside calls, but he was in GME for years prior to the actual squeeze during COVID, right? He was in it for a long time. I think at the time he was calling it like deep value trades or something like that.
Right.
GME and AMC were his primary deep values. So I think that those were, to say he manipulated the market, people only say that because he made a lot of money on it and they didn't understand the dynamics of what he did. So I don't agree with that.
Yeah. Yep, I agree. And Mark, what are the hot meme stocks in the market right now? I know you mentioned a few pre-show here. What are they? Do you know? You have a handful of names that you're seeing?
Yeah, off the top of my head, I put KSS, Kohl's in there, maybe GoPro, Krispy Kreme, which is DNUT.
Donut, yep.
Yeah, DNUT. Did I say Open Door?
Open's another good one.
Jason's point, I don't know if this is a necessary definition of meme stocks, but like similar to AMC and GameStop, like in a lot of cases, these are low market cap, struggling companies that sort of have some sort of like meme cause to them, that like embedded in sort of the investment thesis behind them is not this intent necessarily to manipulate the market, though like that is a feature of a low market cap stock, but like, or that funky thing, I shouldn't say manipulate the market, but like funky things happen in low market, like big liquidity shift, names with big liquidity shifts, like there is some sort of like story behind it that rallies people that get involved with the name.
Mm-hmm.
It's not just,
yeah.
Remember Hertz when it went bankrupt?
Yeah,
that's right. Now, do you guys think? Let's talk a little bit about the Skew here for a second. Do you think in these names that become meme stocks, do you think they naturally trade with a put skew to begin with, or because by virtue of the fact that they're already meme stocks, that they have an inverted call skew component to them? How do you think that plays out? I got to be honest, I've never really looked at one of these prior to being, kind of branded a meme stock. So I don't know what the skew would look like prior to it. Is it just normal, equity skew or not? What do you think?
I did some research on this before because I was asking myself the same question. Like, what did Kohl's look like a month ago? Mm-hmm. And if I can share my screen, I have.
Yeah, go ahead. Sure. We'll get it on there.
It was so like. It depends how you want to start defining skew, but I think an important thing here is look at the scale of the vertical axis. So despite the fact that this is like a pretty big smile, this isn't an index skew where it's like, much more distinctly downward sloping. There's a pretty big smile to this, and maybe those 20 delta calls are trading above the 20 delta puts or 80 delta calls. Mm-hmm. So maybe there's some call skew there slightly, but this is on the scale of like, 10 points of difference between those wings. Yeah. Where if you go to, something like last week when this was going crazy, there's like 80 points of difference, right? So like relatively historically, sure, the wings were bid, but it was a much flatter, like this meme call skewness is when there's like 8x difference between, calls and puts the same delta.
Yeah. And just so folks know too, that when we talk about the skew, and if you're a beginner to options, the two guys beneath me here, Jason and Mark, aren't old enough to be here in the 87 crash, but I happened to live through it. And back then there was a predominant call skew in all the markets. Now, we didn't know what skew meant back then. We didn't define it at all, but upside calls were always bid a little higher because the market only went up. Okay. Back then. And people just bought calls. Options were kind of new to the marketplace, and the investing public just bought calls because they always won. So what did the market making community do? They skewed up that call side just like Mark shows here. Didn't change until the 87 crash, when the market making community realized that downside moves typically are very volatile and have huge velocity, and people come screaming for puts, and then all of a sudden that curve went naturally put skew sensitive. And that's how it existed from then on, right? I'd say, except for some commodities, and that's an outlier. We'll talk about that maybe later. So that's absolutely a phenomenon that happened. And then now we see in the world of memes that call skews back for the same very reason. The demand is so high to that upside curve that people are going to pay for that stuff, right? And it naturally pops that thing up. So that's what that skew means. If you look at a normal skew, you're going to see that 25 delta put be some ball points higher than that 25 delta call normally, right? In most stocks, except in the meme guys when it kind of flips itself over. Any you guys want to add anything to that? Does that make sense?
The long-term average ratio in SPY, for example, is like the puts like 1.4 the call at like the 15 delta level.
Correct. And I made a point to someone. I was doing a call with someone a couple weeks ago, and I said, you could track this. And Jason, I don't know if your software does this, but you could track. And you might use 20 delta, but whatever, 20, 25, you pick your number, somewhere around there is fine. But you could track this on an Excel spreadsheet. You could keep track of it in your stocks that you trade, and you come up with what is kind of a mean value, right? And so, and if you find that, it will fluctuate, and maybe there's opportunity to do certain sort of spreads when it's steeper and certain sort of spreads when it's flatter. And if it's mean reverting, we believe that it's going to tend to go back to whatever that number is, right? And we did that, very much in the trading days a lot. So we knew what kind of the fair value skew was in all of our stocks that we traded, right?
Yeah, typically what I use for seeing skew is Tradier Pro.
Yeah, that's right. So we have that little picture.
You have that.
And quite frankly, if I ever put some time into fixing that up even further, we had the metrics where you could use coefficients to define your skew, and to any person, the coefficients are all mathematical. And you don't have to know the math behind it. You just have to know what a 2 represents. A 2 is a 2. Okay. And if it's trading 4, that's steep. If it's trading 1, that's flat. And that's all there is to it. And if it's always a 2, so be it, And that's what I want to get it back to, where it's that easy to understand. Red, green, and yellow, right? When you go up to the stoplight. I don't know how that stupid thing does it, but I know what to do when I see it, right? So yeah, that's good stuff. What was my other point about this, about skew? Mark, what was my other point? Read my mind, because I can't remember.
I know in your mind. I just see a cartoon.
No, I got it. I figured it out. My other point is this. Someone also asked this question. I think it was a Reddit post again. Where does skew matter the most, or where is it most sensitive in terms of expiry? And I thought that was a good question, because my feeling is that you're going to see fluctuation in skew in scale in the shorter dated kind of stuff, 10, 20, 30, maybe 60-day kind of options, right? Expiries. Once you get way beyond 90, 120 out to leaps, probably not going to see nearly as much. Any thoughts on that concept? Either one?
Well, I think that, if you're measuring it like delta to delta, the shorter term, obviously has like a little bit more skew, especially on the put side of a normal stock. I guess in a meme stock it would be in the call side. Yep. But it also, when you start getting into that area, measurement is a huge deal. Like, a 5 delta put would have a spread of like 5 cents and 10 cents, and a spread of 5 cents, and then just like that measurement. Are you doing call skew or put or bid skew, ask skew, or midpoint or fair value? So like it becomes a lot more sensitive to the measurement style the closer term as well.
Yeah. Okay. Fair enough. Okay.
To measure skew, right? Like sort of to your point, Lex, about that like arbitrary figure, like I have my own arbitrary figure that I just do the dollar value of the puts at the 15 delta to the calls at the 15 delta. One lens to look at it. You can look at it as like a vol point spread, right? It's, absolute vol points. You can look at it as a percentage of at the money vol too. I think that's a pretty common way to normalize it.
Sure.
So yeah, how you measure it is going to dictate how you use it.
Yeah, I think that's fair. That's a good point. Okay, let me ask you this, and this is for the retail folks. Is there any edge for a retail trader to understand this metric skew, so that he or she can place good edge-based trades as a result of a skew analysis. So meaning steepness in a put on the put side. Is there a way to create a spread that makes sense that a retail person could take advantage of that edge?
If you're strictly talking about just using skew and not using anything outside, tracking the height of skew, like if skew is very high, you can probably do a long gamma vertical, and it would be a lot cheaper because the difference between that outside price, the
far price,
the short option price and the long option price are going to be a lot smaller. But conversely, if skew is that steep, it's probably because a lot of people are buying puts, and that's kind of supportive unless something really bad happens. So, so you kind of have to. I wouldn't say there's like I'd say it's something interesting to note, and there's a measurement there. Edge is, strictly using skew. Edge is kind of a harder thing to nail down, but at least you could see skew is very expensive, and at least you can infer a lot of people are buying puts or something like that from that observation.
Right. Okay. Mark, any thoughts on some edge proposition for a retail person with understanding skew?
I think it's probably an interesting angle to understand if you think you see an edge, for example, right? Like, to the fact that there's a reason that a lot of people are buying puts, and like there's a reason that like highly volatile names have can have like a really steep downside skew because of like the distributions of returns to the downside, right? Like if you're thinking about it as like where this is going to settle, a highly volatile name is going to suffer from vol drag and be, if you see a really steep put skew on something. So like, that may or may not mean something's expensive, but like understanding the relative level of skew, I think is just a helpful contextualization of whether the edge you're going for is real or not.
Yep. Okay, that's fair. Here's another Reddit question. Ready?
Ready.
So the retail person said that I follow these meme stocks. I think it's a bunch of BS. I don't get the initial move. I want to fade the move. Okay, should I be buying downside puts naked to take advantage of a downside move? And you two geniuses would say,
I mean, so it's here's the thing that I would note is that first of all, when call skew is high, that means that the gamma crush, like when you see like SPX go down a ton and VIX shoot up, that happens to the upside. If you want to short, if you want to try to catch the rising knife kind of thing, puts are probably a better idea. I mean, you saw what Mark skew looked like when Cole's puts were really cheap, right? Like those puts are really cheap. So my answer is, if you want to try, puts are probably the best answer you could have, although they're probably still expensive, even if the skew is cheap.
Well, yeah, that's the thing. The whole curve has shifted itself up, even though it's tilted itself flat.
Yeah,
it's still expensive vol. I mean, I try to think. I like what you said first about. I think the better play is, if you want to take advantage of the downside, just do one of those put debit spread, buy a higher strike put, sell a lower strike put, and make it really wide. It's probably going to be pretty flat volatility. It's not as good as a put skew, but at least you're not trying to catch a falling knife or pick or time the move down. Or maybe you could even do some sort of broken wing butterfly that might have some cheapness. I don't know. What do you think, Mark? Is there kind of a cool play to do without just scraping up a high volatility put and saying, I hope I'm right?
I think, it's interesting when I was looking at some of these names too, the answer is going to depend on which of these names you're trading, right? Like Kohl's, for example, KSS, 11.15 stock. It got as high as like 20, I think, like during some of that spike. Like there are 50-cent strikes in a lot of these expirations. Like you have a lot of flexibility in the terms of the structure that you can put on to express your thesis. So like there you could do a broken wing butterfly. Tons, I love those. So like, but you've got to have the right strike setups to do something like that. If you go to like a GoPro, GPRO,
Mhm.
that is a $1.35 stock. And sure, they still have 50-cent strikes, but like you're setting up a completely different play on 50-cent strikes in a $1.35 stock. So if you're looking at GoPro and you want to make a downside bet, buy the put.
Yeah, yeah. That I can see the bottom of the ocean on at $1.35. I mean, I think I can touch the bottom of the ocean there.
So I think also in these stocks, especially the ones while they're fast moving, the spreads are going to be really wide. And personally, I would want to keep the number of legs low. So because if you have like a broken wing butterfly, that's going to be 3 legs. You're going to be giving up a lot of edge in that.
Yeah. So you could see a 2-legged sort of put debit spread potentially.
I think I would personally stick with the debits, like a vertical. I would absolutely avoid short gamma at all costs. Do not sell verticals. Don't be trying to collect premium on them. But yeah, especially since Skew, especially if Skew is high.
All right, I got you. Thought of another one.
Okay.
All right, since the Skew's inverted, right, and we got cheapy puts all of a sudden relative to expensive calls. What about this? What about a split strike, like 2x1, buy 2, sell 1 kind of put spread, right? Where, and again, GoPro doesn't work as a dollar stock, but something that's a couple $100. Grab one of those babies and try to get it for even or a small credit. Now you have a great downside. Obviously, you got a sticky point at the long strike, but this we're talking about gigantic dinosaur moves here, potentially. What do you think about that one? That one could look pretty good, huh?
Are you putting the short strike above or below the 2 long strikes?
Well, it's the short strike's above the long strike, so I'm going to buy 2, sell 1. So let's say I'm just making this up. Let's say it's $100 stock. I'm going to buy the 85 put twice, and I'm going to sell the 95 put once, and I'm going to hopefully get a credit or somewhere around even. And this stock, I'm looking for the stock to go back down to 50 or something like that. That's my thesis. If I can get that on for even,
I like that. You'd have to be careful of timing and your expiration selection, but I do like that because especially if you do it like a month out, then you can, the vol tends to be a little sticky until it isn't. That's the one issue that I would have is that you would have to, if your thesis is realized quickly, you'd have to get rid of it quickly because all of a sudden you're long gamma in a very high, in a high IV stock, and you could get the implied volatility can degrade pretty fast.
Yep. That's a good point. Yeah, I'm gonna look at that. Mark, what's a high price one of these crazy stocks? Do you have one?
I was going to say that's a little bit of an oxymoron, right? Like, they're high relative to like bankrupt, but like I don't know how many $100 meme stocks there are.
Well, besides GME when it happened, right?
That's true.
Yeah, that was a good one. Okay. Here's a comment from a good pal of mine.
I like this question.
Good question. Can you guys do a whole show on choosing expirations? Yeah, for sure, Bobby. We're going to do that. That's a great point. I feel strongly about that topic, choosing expirations. And I will just go out on record and tell you that I realize that I suck at 0 DTEs. Just going to say it. That's it. I suck at them. I even suck at 1 DTEs and maybe 2 DTEs. 3 DTEs
I don't have
suck as much.
I'm usually too busy to sit there with 0 DTE. 0 DTE gives me anxiety. I sit there every day.
But we'll talk about that. We'll have that as a topic on the whole show. That's
here. I'll get a plug in here. That's why you need a bot to do it.
I would still have anxiety. I would sit there.
Oh my God! All right, what else? Anything else on these things? Do you want to talk a little bit? What time is it? Are we okay here? We got a few minutes, 3 minutes. Want to talk a little bit about the gamma part of this, the gamma squeeze part of this, and how market makers might set this up? Because my feeling is that this is about one of the few places I could see a gamma squeeze actually being pertinent, strongly pertinent, where the tail could be chasing the dog here a little bit because it just keeps exacerbating itself. Any thoughts on that? I know, Jason, how you're going to feel about it, because you're Mr. gamma squeeze,
Well,
man.
it's because I think you're right, and it's because there's low float, high short squeeze possibility. And it's high call skew, so it's it keeps feeding on itself up, and there's not even like a zero place. It's not, you can't like say, oh, I'm about to hit this bargain on GME, like
right.
if the whole market is coming down from like a small gamma squeeze or something like that from SPX.
Yep.
There are people who will say SPX is now cheap and then buy it, like try to get long and buy the dip. There is no like buy the ceiling. Nobody ever says buy the rip, or sell the rip. In these stocks, they try. People try to catch the knife, but that's only a trade.
Right.
That's not an investment. So
yeah, but I think right. I think gamma has a play here, and I also think Vana does too, because the more demand on those upside calls, the more those dealers get short, and they're going to hedge it, right? And they're going to probably turn to the stock or other things that it's going to push it up. So I can see how this could have a little bit of a a snowball rolling down the hill or up the hill, however you want to look at it, effect. So I definitely believe that could happen here. But these market maker firms nowadays, they're not like when I was in the business, and Mark, maybe you hit this part of the business, but we had people hedging their own books within each stock. Now these market makers, they're gigantic firms, and they just say, throw it into the mishmasher and see how we're doing. Who knows, right?
Yeah, I think hedging techniques continue to get increasingly advanced. And I mean, there's not just market structure reasons or, order flow reasons. It's like back to the definition of a meme stock, like there are like socio-psychological reasons behind it too. And when the stampede happens, that's a customer effect, not just a clique effect.
Yeah, I think option volumes period have gone up so much that like firms can afford to lose something a little bit on GME and then readjust how they're hedging based on it. Oh, look, a low float, high shorted, I can hedge this in a different way, or I can price this in a different way than I do on Microsoft or something else.
Right.
And one thing that I've noticed, particularly because I look at it a lot, is
they're not losing money on GME. I promise you that.
No, you know what I mean. But like, I know they're not, but you know what I mean. Like, I'm just saying that they can evolve, But in SPX 0 DTE, I mean, we've been observing it now for better part of like a year and a half, 2 years on a daily basis. And the changes that you see that are being made like in real time, you could see that there was a shift in pricing, and there's quite a bit of differences that have evolved over time, to the point where, when we did a 0 DTE analysis for the white paper, everything's changed since then. Like they have changed their hedging ways, and then in response to that, there have been now these condors, these premium selling engines, and we see those happen, and then we see how that's how that changes hedging activity too. So I mean, it's there is a little bit of cat and mouse. I mean, we could kind of see it in what we do. Yeah.
Yep, that's good. Okay. All right, guys, good deal here. I'm probably going to get back into the meme stocks now. Great, thanks for this.
Ask your 11-year-old nephew. That he'll know what to do.
I'll tell you, it wasn't a nephew, it was a friend. His 11-year-old.
Oh, friend.
It's the best trade I have made in the last year. That was awesome. Anywho, good to see you guys. Jason, give yourself a plug.
Vol.land and addamnfunds.com. So if you just want information on trading your own, seeing the market maker book, go to vol.land. But if you want somebody else to manage your money for using options to adjust your risk, that's addamnfunds.com.
And Mark, have at it. Give me the plug.
harvestedfinancial.com for bot portfolios and generally using options to manage portfolios, but also the till.substack.com, where you get a new market structure and options trading blog every week. Sneak preview today's is going to be about why you should just jump in and make that trade.
Oh, I like it. Very good. Very good. All right, good. And don't forget to check us out at Tradier at hub.tradier.com, Smart Options Trader as well, and then the Tradier Hub. Those are YouTube channels. Make sure you subscribe to hub.tradier.com because there's some cool things coming. I can tell you that it's only going to be for premium members, and premium members means that you just need to dump an email with us. It is not a paid sort of subscription yet, so stay tuned for that. Great shows during the week, so make sure you check those out on the Hub, and we will see you next week, Thursday at 9 a.m. Central for Traders Workshop. Thanks, guys. Have a great weekend.
Take it easy, Lex.
You too.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.